Hello and welcome back to WinksThinks. Once again, I am your host, Sean Winkler. Welcome to episode 2. At the conclusion of the previous episode, I mentioned that the next time I'd be talking about 20th century French philosopher Gilles Deleuze. But I hope you won't mind if I postpone a discussion about Deleuze until a later episode. For today, I wanted to talk about something that ties in more directly with our present day circumstances, and that signaled a tectonic shift in the socioeconomic and political climate of today's world. That is, the 2007-2008 financial crisis. We all remember the financial crisis, but do we really know what happened? The story begins something like this. On the 12th of September 2008, U.S. Secretary Treasury Hank Paulson called a private meeting with the heads of each of the largest investment banks on Wall Street. Paulson alerted them all that before them lay a world historical task. One of the longest-standing investment banks on Wall Street, Lehman Brothers, was on the verge of bankruptcy, and if the heads of the other banks could not figure out a deal by weekend's end, either to finance Lehman's losses or to sell off parts of the company, by next Monday morning, the bank would cease to exist. And due to the size of Lehman Brothers, the fate of the world literally hung in the balance. Now, 6 months prior saw the decline of another investment bank, Bear Stearns. But Paulson and the U.S. Treasury had brokered and financed a merger between Bear Stearns and J.P. Morgan Chase. Despite efforts to sell Lehman's assets to other American firms and another to sell to British bank Barclays, this time there would be no deal. Lehman's assets were far too toxic, and Paulson thought it best to send a message that no bank would be too big to fail. He stated, quote, "I never once considered it was appropriate to put taxpayer money on the line in resolving Lehman Brothers," end quote. An ironic statement considering Paulson's later role in the bailout. As predicted, on Monday morning, the 15th of September 2008, Lehman Brothers, which had survived the Great Depression and the September 11th attacks, shut down for good. 9 months prior, Lehman had stood upon a record $4 billion in profit. Under the management of CEO Dick Fuld, Lehman Brothers stock had made a 20-fold increase from 1994 to 2007, from $4 a share to $82 a share, and at its peak, being valued at $85 a share. On the 15th of September, however, its shares were worth only 3 cents. By the end of trading that Monday, not only had the country faced the largest bankruptcy in its history, $700 billion had already vanished off of the market. The worst of it, so it seems, was only beginning, and the world was headed for a complete financial meltdown. When it was all over, $5 trillion in pension, real estate, 401k money, savings, and bonds would disappear. 8 million jobs would be lost, and 6 million would lose their homes, and that is in the U.S. alone. There would be a total loss of some $15 trillion worldwide, 30 million would go unemployed, and many more would go homeless. It was an event that has forever altered the socio-economic and political landscape of the entire globe. An event that precipitated within a matter of just a few months. At a hearing before the U.S. House Committee on Oversight and Government Reform on the 6th of October 2008, Lehman's Dick Fuld was asked exactly what had happened and, moreover, why he believed Lehman was allowed to fail. He admitted, quote, "Until the day they put me in the ground, I will wonder," end quote. Martin Wolf of the Financial Times of London, and one of the foremost voices on economics in the UK, echoed Fuld's disbelief and confusion in the following quote from the PBS documentary, Meltdown. Quote, "The economy is an extremely complex, adaptive system. I think it is the most complex system that we know. But you will never foresee these things, as the system is ultimately too complicated for anybody to really understand," end quote. The world economy was in the midst of its worst catastrophe since 1929, and no one, not even one of the leading experts on the subject, seemed to know why. We know now, however, that this is simply not true, as for some people, the crisis was not unexpected. The writing was and had long been on the wall. For episode 2, I wanted to tell the story of those who saw the crisis not as an act of God, but as the inevitable outcome of human behavior. This is the story of The Big Short. The Big Short is the title of a book from 2010 by Michael Lewis, a former bond trader with the now-defunct Wall Street firm Salomon Brothers, and it's also the name of a movie from 2015 directed by Adam McKay. Through an analysis of The Big Short, I want to provide an answer to the question, what exactly happened during the economic crisis? I'll be discussing both the book and the film, while also drawing details from the three-part BBC documentary, The Love of Money, and the PBS mini-documentary series, Meltdown. There are many problems, I think, in the presentation of both the book and the film, The Big Short. Where both succeed, however, is in the gesture of showing that the abstruse language and convoluted logic of the financial world are simply there to intimidate you and to stop you from asking questions. And even if the book and the movie do not always point you in the right direction, they can tell you you are not only right to question, you do not have to be powerless. Now, before we get into discussing the interpretation of the financial crisis provided through the lens of The Big Short, I want to mention something important which is neither discussed in the book or the film. Here, we're discussing a financial crisis, but what exactly is an economic crisis? No agreed account of the phenomenon exists. Now, I'll forego the debates about definitions, but I want to borrow one that I find rather convincing and that offers a general framework for reducing the complexity of even the most recent crisis to a simple formula. That is the definition of Frankfurt School economist Henrik Grossman, which appears in his essay, The Theory of Economic Crises. He defines the term as follows. Quote, a crisis in a capitalist economic mechanism occurs when a certain amount of merchandise of a definite value cannot be sold within the limits of the said mechanism. In other words, a crisis occurs when a business or industry is confronted with the problem of having to find new purchasers of its goods, but fails to do so in such a way that it ceases being capable of producing that good in the first place. In the case of the 2008 financial crisis, the industry in question was that of real estate, and the goods in question was debt, specifically mortgage loans. Because real estate was perceived as such a reliable market, individuals and businesses of all kinds invested heavily in housing, putting it not only at the center of the American, but the global economy as well. So when the crisis set in this particular industry, it set off a chain reaction that affected every other market across the globe. With that, we can begin discussing The Big Short. Now, in this discussion, I'm going to forego talking about individual characters and plot, because what interests me here is the explanation provided in the book and the film of the financial practices and mechanisms that precipitated the crisis. The book and the movie focus on these financial instruments to tell the story. The mortgage loan, the collateralized debt obligation, or CDO, and the synthetic collateralized debt obligation, or synthetic CDO. They come into play in the following manner. From the end of the Second World War up until the crisis, the housing market was considered to be the closest thing to a risk-free investment for those buying, selling, and investing in real estate. The only direction that market was considered to go was up. Coming to own a home was the wish fulfillment of the American dream, but also the lifeblood of the American economy. Now, prior to the 1970s, investing in the housing market meant a safe but slow-going return on one's investment. For this reason, it was a market that did not appeal to high-yield bond investors. Not enough risk, therefore not enough reward. Louis Ranieri of Salomon Brothers, however, changed all that by taking mortgage loans and transforming them into a kind of security that he believed would be more lucrative. His invention, the mortgage-backed security, the first financial instrument at play. The mortgage-backed security, or mortgage bond, was a security assembled from pools of mortgage loans of varying levels of risk. These bonds consisted of hundreds, if not thousands, of different loans. The pools were also stratified and ranked by various degrees of quality, starting from the top at AAA, the highest, down to BBB, the lowest. The pool of mortgages rated at AAA consisted of those loans to people with the most stable, high-paying jobs, as well as the best credit scores. The pool of mortgages rated at BBB being the opposite. If a person or business wanted to invest in these mortgage bonds, he, she, or they would purchase what was called a tranche, the French word for piece, at any one of these various levels. Now, if you wanted to make a safer investment, you purchased a tranche of the AAA bonds, because those bonds were invested in by a larger amount of people and consisted of loans at fixed interest rates. Their return was smaller, but better guaranteed. If one wanted to make a riskier investment, however, one purchased a tranche of the BBB mortgages, bonds that were invested in by a smaller group of people, and which consisted of some prime and sometimes variable rate loans, meaning that their return was potentially higher, but also with increased risk. Now we proceed with the second financial instrument in play before the financial crisis. So in order for investment banks to continue creating these new bonds, banks had to continue creating new loans. But at a certain point, only so many people can afford homes. This means that the banks have to grant loans to more and more people, now with lower incomes, lower credit scores, and more precarious employment. Borrowers were then led to believe by the banks that they would be able to pay these loans, because the banks wrote contracts that contained confusing and misleading language, one of the most important details in the fine print being that of the adjustable interest rate. At their most extreme, banks issued so-called ninja loans, which stood for those loans that banks issued to people with no income, no job, or assets. Now, from the investment point of view, it's difficult to entice individuals or businesses to want to put their money in bonds consisting of loans this risky. So the investment banks started doing something new. They began to take the tranches of bonds that consisted of higher risk loans, the double Bs, the triple Bs, and repackage them to make them more appealing. In order to do that, they brought them to ratings agencies to have their quality reassessed. Ratings agencies are, of course, a business of their own, and if one rating agency does not provide the desired rating for a bond, a bank can simply take their business elsewhere. Ratings agencies, then, have an incentive to give bonds the best rating possible. These new repackaged bonds, what are known as collateralized debt obligations, often meant that initially double B or triple B tranches were rated as high as AA. But because the belief in the housing market was so strong, these practices were considered safe nonetheless. There's a nice explanation of the collateralized debt obligation, or CDO, in the film by the late great Anthony Bourdain, who explains it in terms of putting 3-day-old fish into a new soup. He says, quote, "Let's say you order fish on a Friday. Not all of the fresh fish sells. Whatever doesn't sell, put into a seafood stew. See, it's not old fish, it's a whole new thing. And the best thing is that it's 3-day-old fish. That is a CDO." Now we're almost done with the setup, but there's still one other aspect of the market that factors into the crisis, the so-called synthetic collateralized debt obligation, or synthetic CDO. Now these are investments that are not made directly into a particular market, but that function as a bet on a particular market, again in this case, that of housing. This is well explained in the film through an aside with Selena Gomez and Richard Thaler at a scene at a blackjack table in Las Vegas. They say, let's imagine that the people playing blackjack are the investors in mortgage bonds. Their bet is analogous to a tranche of one of those bonds. But let's say people around the table want to start making bets of their own on whether or not the players at the blackjack table win or lose. Those people go ahead and make a side bet. Imagine too that it doesn't stop there. Someone bets on that bet, and then bets on that bet, and so on and so forth. So here's the takeaway from all these different financial instruments. Because the housing market was considered safe, banks and investment banks believed that the creation of any loan or security, no matter how risky, would always be offset by the steadiness of the market as a whole. But this assumption would eventually prove self-defeating, as it created what was effectively a giant Ponzi scheme. Combined with the fact that banks were making money from loans and investment banks off the processing fee of the bonds, they were making billions in the transaction of these products alone. And these more and more corrupt financial instruments consumed a greater fraction of the market. In the mid-1990s, the market for subprime lending was $30 billion. In 2000, the subprime lending market totaled $130 billion, with 55 of that being in mortgage bonds. As of 2005, the market for subprime lending totaled $625 billion, with 507 of that being in mortgage bonds. And that does not even count the amount of money bet on those mortgage bonds through synthetic CDOs. This makes for a staggering amount of money, all banking on the success of an increasingly toxic market. What we also learned in The Big Short is that the success of the housing market was not an eternal law. In the middle of the Great Depression, the housing market had dropped nationwide by 80%, and half of mortgage debt went into default. People had only come to the assumption that the housing market was a sure thing because it had been so reliable for so many years. But a collapse was set to happen again in 2007, because in the year 2005, a critical amount of subprime loans had been issued, and 75% of those loans were issued at 2-year adjustable rates. The borrowers on those loans were already struggling to make their payments, and so when the adjustable rates kicked in 2007, they would be unable to make their payments. When they would be unable to make their payments, the value of the mortgage bonds and every other financial instrument correlated with it would plummet in value. So to tie it back into Grossman's definition then, here is the crisis in a nutshell. Banks made money on issuing mortgage loans, and investment banks made money on packaging those loans into mortgage bonds to issue to investors. In order to continue making a profit from these products, they had to create these products in ever more dubious forms. But since the product they were dealing in was debt, when it turned out the debts could not be repaid, it was no different than any other company being unable to sell its product. This brought the housing market to a standstill, and with it, essentially every other aspect of the world's economy. Now, I want to include with a reflection on what I see as not only being a major theme of the book and the film, but of the financial crisis in general. And that theme is that of the unknown known. Now, this phrase doesn't appear anywhere in either the book or the film, but I think it's suitable to describe the theme at work here nonetheless. Well into the crisis, Queen Elizabeth II met with a committee of economists at the London School of Economics, and she asked why, if they were all so intelligent, they had been unable to see the crisis coming. They didn't answer her question at the time, but in a subsequent exchange attributed it to a, quote, failure of imagination. So oddly enough, this was a phrase utilized by former American Secretary of Defense Donald Rumsfeld to describe how the United States had been unprepared for the attacks of Pearl Harbor and 9/11. I believe, however, that the LSE economists would have been more accurate if they'd referred to another component of Rumsfeld's so-called epistemology, or his theory of knowledge. In the lead-up to the Iraq War, when asked about the possibility of a nuclear weapons program in Iraq, Rumsfeld answered in his typically mercurial manner by laying out what he saw as three distinct kinds of knowledge at play in drawing conclusions for intelligence. There are known knowns, things that we know, known unknowns, things that we don't know, and there are unknown unknowns, things that we don't know. Rumsfeld, rather ironically, omits an obvious fourth possibility, one that would prove disastrous considering the U.S.'s course of action. That category is that of the unknown known, the assumptions that you make without even realizing it. This omission is the theme of a documentary by Errol Morris on Rumsfeld, as well as the writings of various philosophers and critics who write about the subject. But this theme is at play in the context of the economic crisis as well, and it is emphasized in the film's opening quote by Mark Twain, which reads as follows, quote, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." End quote. One of the obvious unknown knowns at work here is, of course, the unwillingness to see the housing market as something other than a sure bet. This assumption led to careless and frivolous financial practices that exploited and ruined millions. But there is yet a second way in which the unknown known is at work here as well. Many have criticized the book and the film for indulging in the very pomposity of Wall Street that it sets out to criticize, and to some degree, I'm not unsympathetic to this criticism. If I may, however, I believe that the book and the movie show the remoteness of people like the characters in the film and in the book to the majority of what the world experience. It may often be hard to see this in both the book and the film, as there is only the occasional reference to seeing people suffering. But there's one moment in the movie in particular where the gravity of ignorance is shown to be at work. In another scene in Las Vegas, two of the main characters, after having just bet against the housing market, realize that they are set to make millions and begin dancing in a hotel lobby. One of the other main characters, however, immediately scorns them and shouts the following. Do you have any idea what you just did? You just bet against the American economy, which means if we're right, people lose homes, people lose jobs, people lose retirement savings, people lose pensions. You know what I hate about fucking banking? It reduces people to numbers. Here's a number. Every 1% unemployment goes up. 40,000 people die. So don't fucking dance. Here, we see the perhaps biggest unknown known of the film, which is that of the market and profit incentive itself, to the exclusion of human life. We often forget that the central component of the market, money, is a commodity like any other. Like cotton, wood, apples, oranges, steel, as with any of these things, money has a value. But there are two major differences between money and any other type of commodity. First, you can't go into a store and pay with a bag of cotton or a bag of apples. For that, you need money. But money, while a commodity, is a special kind, one that mediates the value of each and every other type of commodity on the market. It is a universal means of exchange, and the more you have, the more you can access. Unlike other commodities, other than serving as a means of exchange, is utterly useless. Unlike apples and oranges, you can't eat it. Unlike cotton, wood, or steel, you can't build or make anything from it. Money is simultaneously the key to other commodities, and yet useless unto itself. Within this contradiction, we see a final unknown known being spoken to in the film, one that can perhaps be seen as a tiny glimmer of hope. The market is a sign of an agreement, an interdependence among people, meaning that the market itself is only as powerful as our belief in it. With that understanding, human beings not only should, but do come first. And if that's true, human beings also have the power to change it. With that concludes episode 2 of WinksThinks. I thank you for listening and hope that you will join me next time. This is Sean Winkler. Farewell and good night.